Okay, so that's kind of the key issues, where we've been, sort of where we stand at the moment, where we're going next. Well, for me, again, a bit of balance. You've got to acknowledge that there's some tough times to come, but also there's some buffers in the system. So we shouldn't really get overly pessimistic. Now, one thing that is a concern is housing affordability. So this does come down on the negative side. We've still got stretched housing affordability. So things are improving a little bit. We've had incomes continue to rise. We've had house prices fall. So that does help housing affordability improve, but it's only small and it's from such a stretched position. I just think housing affordability is going to remain a handbrake on the market for a while yet. As I've got on this subheading here, I think it certainly delays the start of the next upswing. And also could cause some regional differences. So just to illustrate, the chart on the left, we've got the value to income ratio, pretty standard measure of housing affordability, and lighter purple there. You can see it's improved. Like I say, that purple line started to tick down, but look where it is. It's way above its average. It's way above past peaks, still really high. So there's been an improvement, but housing affordability is still pretty stretched. Same thing when you look at the share of income required for repayments. That's the darker blue line there. This is how much of a household's income is being absorbed by mortgage payments. Again, you can see that's just ticked down a little bit. So on these charts, down is better or down is more affordable, but still really high. So you're still looking at, on average for a new mortgage, 50% of household income required to service that debt. Still really high. So yes, it's improved, but it's still pretty stretched. So yeah, this is probably something for me that's still a key issue to keep an eye on, and certainly delays the start of that next upswing. On the right hand side, that income measure broken down by main centres. So how much income required around the main centres to service a standard mortgage. Again, you can see that message. Yes, it started to improve. It started to go down, or things have started to get more affordable. But each of those lines for each of the main centres is still really high and still higher than typically where it's been in the past. So I'm still stretched pretty much wherever you look. Might cause some regional differences though. You can see Christchurch there in pink. Yes, things have got less affordable in Christchurch, but that pink line is still lower than each of the other main centres. So there are regional things going on here. Christchurch is still more affordable than the other main centres, and probably has a role to play in why house prices have fallen less in Christchurch and other parts of the country. Okay, so affordability, not great at the moment. It's improved, but it's still not great. That is one of the things that feeds into this vulnerability indicator that we've done. Now, I'll circulate the slides afterwards, or circulate them to Cameron, and he can send them around. But this you can study this at your leisure. But what we've done here is try to give an indication of which parts of the country are more vulnerable to falls than others. So it's not meant to be an absolute indicator. It's a relative thing. It's where are the greatest risks or the least risks. So yeah, you can see here on the left-hand side, most vulnerable. We've got some smaller provincial areas there. Across to the right-hand side, least vulnerable. And a lot of those least vulnerable markets tend to be Canterbury. You've got Christchurch, Waimak, Ashburton, Timaru. So those are the parts of the country we feel are least vulnerable to a downturn. Not saying they'll avoid price falls altogether, but probably less vulnerable than other parts of the country. So yeah, if you're thinking about where might be the safest part of the country, at this point it's probably Canterbury in terms of the housing market. Most of the main centres pop up in the middle there. You've got Hamilton, Wellington, Dunedin, Tauranga, Auckland. So not too hot, not too cold, but so yeah, in other words, some risks, but not complete disaster either. So mid-range for a lot of those main centres. Interesting, Upper Hutt and Lower Hutt do appear towards the more vulnerable end of the spectrum on our indicator, and so it's been sort of reassuring in terms of our analysis to see that they have actually performed. They've been amongst the weakest performing markets. So the indicator's been working okay, and I guess the key message is that it just might help to give you a sense of, depending on what you're looking to do in the property market, what you think about the property market, might just give you a sense of where the greatest risks might lie. Okay, economy still holds a big key in all of this. Whatever happens today with the official cash rate, inflation, whatever happens in future, the labour market holds a big key. So I just think if unemployment can stay low, it's not preventing price falls by any means, but I think if unemployment can stay low, this downturn can remain orderly or controlled, whichever sort of phrase you want to use. It doesn't have to be a massive crash. So the unemployment rate does hold a big key here. That's one of the buffers, one of the reasons to not get too pessimistic. We've also got LVR rules. That's built a buffer into the system. Like I said earlier, mortgage serviceability has generally been tested at those higher rates. So, that's a little bit of a buffer as well. A lot of people are ahead on their mortgage repayments. So there are some reasons for comfort. It's not all doom and gloom. And I think the low unemployment rate does hold a big key. So this will be something to really keep an eye on next year. Unemployment stays low. That should keep the downturn relatively orderly. So where to next? Going okay for time. I've hopefully covered off most of this. I think in terms of where to next, for me, it's still an orderly correction. I mean, prices are falling for sure. I think the latest inflation data and the OCR upgrades will certainly have implications. It probably prolongs the downturn, makes it a bit deeper than it otherwise would have been. But I think it's still relatively orderly. We're not seeing huge repayment problems, mortgagee sales, these sort of distressed sales. We're not seeing that. And that's the thing that can really turn a slowdown in the housing market into something much more significant. So we're not seeing those things for now. It's still relatively orderly. Things are ticking lower, but we're not seeing those really distressed sales. So for now, I'm still calling it an orderly correction. As I've got on these notes, inflation stubborn. We could see mortgage rates headed higher. We've probably got the next step on that path later today at 2 o'clock with that OCR decision. So I've covered all of that. I mean, you do have to acknowledge there's a risk of a recession here and rising unemployment. As I said, unemployment does hold a big key in terms of what happens in the property market next year. If we see unemployment stay low, I think we can see the downturn come to an end. But if unemployment did start to rise, then there's that recession risk, and there is a risk that the housing downturn goes on for a bit longer. So still lots to keep an eye on. I think overall, there's definitely some buffers there, but I think we're certainly into phase 2 of the downturn, and that downturn isn't over yet. So previously we were thinking there'd be a 15% peak to trough decline in house prices. I think with the latest inflation data, that higher OCR, I think that's probably now going to be more like 20% from peak to trough. So we're down 8 to 10 already. And I think so we've probably got about another sort of 10% to go to get to that 20% figure. So downturn's not over yet. And I think we'll see further sales activity into 2023 as well. So unfortunately, the message isn't great. I think if you're a property owner, it's not great. If you're looking to buy a property, fantastic. You want to see prices fall, but I think whatever your perspective, we're going to see further price falls, certainly into the first half of next year. But if we can start to see mortgage rates peak, if we can see unemployment stay low, I think if we came back in a year's time, November 2023, if unemployment's still low and mortgage rates have peaked by then, I think we'll be starting to talk about, or certainly talking about by then, the end of the downturn. I think second half of next year, that's when I'm targeting the end of this downturn. Some stuff on the election there. I won't linger on that. We'll see what happens with the election. And I've covered off the debt to income ratio stuff already. So like I say, overall, the message is still downbeat. We've got further challenges ahead, but you do have to balance that out. There's also some buffers. So look for the end of the downturn at some stage next year, perhaps into the second half.